Hey everybody, welcome back to the whiteboard. This week we are going to talk about a topic that is front and center in the news with Cracker Barrel and having some fun, which is what is the value of brand and how do you think about it? So I wanted to connect a few of our previous whiteboards to how I think about brand today. And the first one is this handy little 4x4 chart showing the real if you chart volume over expected value, you end up with these four quadrants. You end up with low volume, low expected value, they're kind of mysteries, things that might be good, but they currently don't have enough interest, things that could be profitable in the future, but the tech isn't there, or the audience alignment isn't quite there. You've got really high expected value and really low value, those things are gems. If you can get them, you mine them. We've got high volume, high expected value, those are money printers. The things that you can continually spend money on and get money back. And you've got high volume with low expected value or just money incinerators. They're expensive, they're everywhere, they cycle through your budget. This applies to keywords, it applies to audiences, it applies to platforms. Right? So as you think about this, my overriding principle is that the default state of every business is failure. Everything that you do as a marketer, as a business owner, as an investor, is fighting the gravity that wants to drag you from gems and money printers to mysteries and money incinerators. That's what we do every single day. Every ad you create, every lander you launch, every product you ship, everything you do is focused on fighting this gravity. That sounds morbid, it sounds cynical, but it's the reality. If you leave your business alone, if you stop working on it, if you stop working on your product, your business will fail. We all know that, right? Because none of us leave our business and expect to continue to make money, right? This is the reality. So, where does brand fit into that equation? My argument, my belief is that brand is basically buoyancy. If gravity is what's dragging this down, brand is like a hot air balloon that rises up, that slows the rate at which gravity acts on the business, right? That's pretty much what it does. And like a hot air balloon, it takes a long time to fill it up, but one little pop and the whole thing comes tumbling down in rather spectacular fashion. So that's how we got to Cracker Barrel, right? They had a pretty spectacular pop that has resulted in a absolutely maybe even over-covered fireball coming down as that brand craters. So how does that help you with media buying? Well, it turns out that there's actually a pretty nice relationship between brand strength, brand equity, and paid media success. And it shows up when you start to look at efficiency over spend, over volume, right? Using this same chart, just applying it over here, right? So what I did, if you come here, is we just charted efficiency, right? Just like this, expected value, efficiency, right? Same concept. And volume, we used spend as a proxy for volume, right? Same concept, just applied here. Well, let's look at two brands. The blue is a strong brand, a brand that is well-known, well-respected, prominent. The red is a brand that is not. What you see here are two things. Number one, the rate at which the blue curve declines is much shallower, right? You can see there are drop-offs. You can even see there are inflection points in the curve, but it's very gradual. For the red, it's much steeper. And number two is the time above break-even. For this blue brand, we haven't even gotten to break-even yet, and we are to my left on spend. For the red brand, we hit a point where every incremental dollar spent is done at a negative efficiency, meaning you are losing money. And we can measure this efficiency in any way. You can measure it in expected value, you can measure it in lifetime value. However you measure it, at the end of the day, there is a point where the efficiency curve crosses the threshold. It happens for every brand, even strong brands. It just depends on how long it takes. And then there's a second point, which is the absolute break even, which you can see here is actually right here. And this is the point where all of the surplus value, all of the profit, all of the positive contribution margin, whatever definition you want to use, that you generated at the beginning, which is this, the area under the curve here, evaporates, goes to zero. Basically, you are spending at negative efficiency. This is where you rack up positive efficiency. This is where you rack up negative efficiency. And when the area here exceeds the area here, you start absolutely losing money. So when you look at this, you say, okay, well, there's a really clear way we can see just how impactful brands are. And we can see this across the board, right? We work with lead gen with B2B companies that are generating leads. We work with B2C companies that are selling products. We work with B2C lead gen. We even work with B2B companies that actually sell things online, like sell things to other businesses. The same curve applies to all of those businesses. It applies across the board. Yes, the thing that you're measuring and the connection to revenue or to profitability does vary. You have to convert leads to, transaction value or deal value, whereas sales are pretty transparent. But all those things aside, it's pretty much the same thing. So we get to this point. The difference, the measurement of the strength of the brand, is then the difference between these two curves. Because fundamentally, in this case, I'm actually charting two B2C lead generation brands, and we are using deal value as this efficiency, right? So there is a point where generating more leads actually has a negative value for this brand because they can't service the leads. They're spending money to acquire those leads, but they can't close them at the rate that they want, or the leads are coming in too expensive for them to be worth closing, right? They lose money on the leads because your sales team is 6 people. Well, if you're getting 600 leads a day, those 600 people cannot efficiently service 600 leads a day. Doesn't happen. Plus, those 600 leads a day are coming in at progressively more expensive incremental costs, right? That is a baseline tenet of all paid media. All things being equal, the next dollar, right, is less efficiently deployed than the previous. Every incremental click is more expensive than the previous, all things being equal. What we try to do as media buyers or as marketers is to make things not equal. And we make those things not equal through both long-term investments in brand and short-term investments in basically performance accelerators or performance catalysts. And the combination of those two things, when it dovetails, is what gets you to this strong brand position where, as you can see, this brand is fighting the gravity much more efficiently than the red brand. So, since we all love our financial analogies, right, here's one I'll make for you. If you think about everything that we do as a capital investment, as capital allocation, right, paid media is basically a bond. It's how you should approach it. We put money into a bond, we get dividend payments out, and we get paid back over time, right? That's what we do. We put money into paid media, and we expect to be paid out some amount now, and then some amount over the rest of time. We are pretty clear about what that payback looks like because we set things like bid caps or cost caps. We throttle budgets up and down based on performance. It functions like a bond. And obviously, some bonds can go underwater. And for instance, if you make a loan to a company that is already underwater, well, what's going to happen? What happens here with the red? You made a loan to a company underwater, and what happened to the value of that bond? It went way down because the company cannot pay for it, right? The brand cannot service it. That's what happens. So when you think about paid media, it's like, okay, that's a bond. That makes brand essentially an equity, a stock, ownership in a company. Equity investments, for anybody who's done any kind of startup investments, will take a long time to mature, and it's not a linear process, and it's most certainly not clear and obvious, right? You will make an investment in a company and not see a return potentially for years, but then at some point the company hits an inflection point, takes off, and now your initial investment is 10x or 100x or 1,000x or 10,000x what it was. That's the investment in brand. So like any balanced portfolio, you need bonds because those are reliable, durable sources of income, assuming they're risk adjusted properly. And you need equity because that is the stuff that allows you to make long-term transformational, dramatic increases in value. So when these two things are paired together, what you get is something that looks like this blue curve. It's a beautiful thing where you can spend and spend and spend and spend on paid media at positive efficiency for a substantial amount of time. And when you have a weak brand, you hit a point, and you hit it sooner than you'd like, where you simply cannot spend more money. That's how it works with positive efficiency, right? Now, the other thing is having the great brand is nice, but you're like, okay, well, what goes into that? How do we build that? And the answer is drop by drop over time by investing in the brand experience. And what do I mean by that? I mean, from a paid media standpoint, it's very simple. Align the ad and the lander and the brand concepts together, right? Make sure that there is congruence between who you are as a company, what you're putting into the market, and the experience you deliver when they visit you, right? It is, making sure that your reviews, your word of mouth, your influencers, your referrers all talk about you in a certain way, in a positive way, and they are willing to share that experience, right? Your product or service and the experience of it. That is the experience that ultimately defines the brand. Is you can have the best marketing in the world and the strongest brand belief in the world, right? But if somebody comes and experiences your product or service and it fails to live up to the promises that you've told them, you're going to end up in this red position like overnight. And it's moment creation, right? This is like my favorite Amazon story, is that Amazon's brand was so strong, they could create a 4-day holiday in the middle of summer and drive billions and billions and billions of dollars in sales. That is moment creation, right? These guys said, you know what? We're going to show you just how strong the Amazon brand is. We're going to make all of these retailers give us insane deals in the middle of July. We're not going to tell them when it's going to happen. We're going to pick a day, and we're going to pick it probably in June because, whatever. And we are going to make customers give a damn, interrupt their vacations, shop from the beach to buy this stuff. Watch this. And they did it. That's what Prime Day is. That is moment creation at a colossal scale. Obviously, not all brands are Amazon and not all brands can do that, but you get the idea. The power of the Amazon brand is so strong that they can create a 4-day holiday out of nothing and make people give a damn, right? These are the brand experience points that help you rise this level up. And then when you ask, okay, well, how does this actually work? What are the mechanics? Where do I see the impact of brand? Well, the answer is pretty simple, right? Number one, pricing power. Salesforce charges more than Zoho, and they can. Not because Zoho is an inferior CRM product. It's actually probably not. Zoho might actually be a better product, which is really the irony. But Salesforce is a known and trusted brand. It has pricing power. Under Armour has pricing power over Champion. Starbucks has pricing power over whatever random coffee shop you want to talk about, like Dunkin', right? Those are strong brands, and Dunkin's a strong brand, to be honest, but Starbucks still has pricing power. And there's a reason that, as we get closer and closer to September and fall, that, the number of people wearing Uggs and leggings getting PSLs will increase dramatically, right? That's the power of Starbucks, right? Number two, creative resilience, right? One of the biggest expenses that we don't talk about is the cost of creative. If you are a weak brand, you will often find yourself introducing more and more and more and more creative more and more and more frequently because the rate at which your creative decays or degrades is rapid. For a strong brand, not so much, right? Nike can run the same set of ads for longer than Champion or some random Shopify athleisure brand because Nike's brand equity carries that asset for longer and longer and longer, right? Well, ultimately, that just means Nike has more money available to reinvest into product or paid media or experience. It's really all it comes down to. They're lower risk, right? What shirt am I going to trust? What brand am I going to trust? Well, Salesforce is risk-free. Zoho is like this unknown thing that's kind of weird. I wonder who has more trust. Salesforce. It's the same reason why, when large companies are choosing what consulting firm or what agency to hire, and Accenture comes walking through the door, those companies are like, sure, Accenture Digital sounds great. Deloitte Digital sounds like a winner. Are they actually good at paid media? Hell no. But as far as risk goes, no one ever got fired for hiring Accenture. That is the power of brand. And the strongest benefit of a brand, right? The strongest, easiest way to measure the brand is the fact that it is anti-fragile, right? Because what does this curve show you? It shows you that if all of a sudden this industry faced margin compression from something like, say, tariffs, right? That all of a sudden meant that your COGS or your cost of delivery or your cost of service increased 20% overnight, which means that your CAC, your cost to acquire a customer, needs to drop by, say, 25 or 30% just to break even. Well, who is in a better position to absorb that? It's the strong brand. Because the strong brand has pricing power. The strong brand has a curve that is much flatter, so the strong brand can spend into a constricting or a negative environment, whereas the weak brand is going to get folded. Like, imagine if this line just moved up to here. Well, okay, so if I move that line right to here, sure, that's where the blue brand gets cut off, but if I keep it going, that's where the red brand gets cut off. This brand is donezo. There's no way they're even paying their fixed costs. This brand is growing because they can keep spending for 2, 3, 4, 5x longer. It's a no-brainer, right? So if you want to measure brand, the easiest way to do it is to see how much more you can spend into inefficient before you reach the point of inefficiency, right? That's it. Because a true brand is buoyant, right? It will keep you above this line for longer than your competition. So as we look at and watch Cracker Barrel implode, and we talk about, well, what makes brand powerful and how do we measure that? How do we evaluate our investments in brand? We evaluate them like equity investments. We evaluate them based on their long-term potential to deliver higher returns as measured by both longer spend at higher efficiency and as insurance against negative externalities, right? It is an insurance against paid media inefficiency or negative externalities, things like tariffs or labor shutdowns or whatever else, right? Strong brands can persist, weak brands will fail. So from a financial perspective, this is why it is often paradoxical to say that brand investments are often the highest margin investments you make. You just don't know when you're going to reach the margin. And it's also why paid media and investing only in paid media over time will actually produce lower and lower returns. And I say this as somebody who runs paid media for a living. Paid media is a bond. You can have a great return short-term investing in bonds. But long-term, you want to be in equities because equities are what will rise over time. And a healthy portfolio has a balance of bonds and equities. So when I talk to clients and they say, hey, our growth has stalled out on performance, I often come right back to this chart and I say, well, how much investment have we made in brand marketing and brand experience? Because it seems like what we really need to do is flatten and raise this curve. And the way to do that, paradoxically, is not better efficiency on your paid media. It's providing brand investment that lifts the paid media up, right? And I think any person who follows like D2C Twitter has probably seen people like Cody Plofker and Jason Panzer from Hexclad. If you don't know Jason, you should follow him. He's a great follow. And even Matt Bertulli from Pella and Lomi all say that the way they have unlocked new tiers of growth was not better performance marketing. It was investments in brand marketing. Because those brand investments provided the buoyancy to lift this curve up and allow them to spend far, far more than they were spending before at profitable efficiency, which gave them the cash to invest even more and spend even more and grow even more and launch more products, create more moments, and get to the level of scale they're at today. So there's a lesson in there, which is at some point, you need to move from bonds to equities and you need to rebalance your portfolio. So I hope this gives you a reason not just to say brand marketing is a good thing and we should try it, but brand marketing is a long-term investment that we should continue to make in balance as part of our overall marketing portfolio. We'll talk to you next week.